This video is a Pendle.fi tutorial. Pendle is a crypto yield derivative protocol. Sounds complex, but what this is a way to trade the yield of crypto tokens. You can fix your income over a certain period, or you can trade the yield of a token if you think that it is mispriced. So we're going to go through how this works and then how to use this protocol in this video. Timestamps for everything down in the description. Pendle works by splitting off the yield of all the tokens that we own. There are many of these in crypto. For example, ETH staking tokens pay a yield. Stablecoins across DeFi earn yields as well. So what we can do if we own these tokens is to split off the rights to the yield that we're going to earn. And then we can sell that to someone else. And so what we do here is we take a token that we own, for example, staked ETH, that is going to be paying around 3.5%, something like that. And we can sell that to someone else, and they're going to pay us 3.5% for the yield over a certain time, let's say 12 months. Why would they do that? Well, obviously they think that that yield token, the yield part, is going to be higher than 3.5%. So they fix our yield. We sell that to them to 3.5%. We get that for sure because they pay us that. And then for them, they're taking risk that the actual yield may be 4% or higher. And so they take the benefits and the extra yield. So we get fixed income and they take the risk, but they're doing that because they think they're getting a better reward. And of course, on Pendle.fi, you get this thing here, which is called the principal token. So this is what the people are paying you for the underlying, right? So we own this token, and if we have this, then we are getting what they pay us, that 3.5%. This yield token is basically the risk token where whoever buys this is having to pay the yield, but then they either get more or less depending on what the actual yield is in the real market over the time of the smart contract, which could be any length of time. Pendle does this by creating those two tokens, PT, principal token, and YT, yield token. So these can be traded separately. So as an example, if you had 100 DAI staked in Compound, which is a lending protocol, you of course have the 100 DAI, which is the principal, and then you have the expected yield from the interest that you earn plus any other incentives. And so that's the yield. And so what you can do is trade the yield. If you have the principal token, you can trade out the yield and sell the rights to any income that that token may earn over a certain period. So what you do is go and mint this. So you put the 100 staked DAI into Pendle, and they will give you a PT and a YT. We now can trade separately the principal and the yield of this token. So we can do this for many tokens, and this enables us to fix our income if we have this, or it enables us to actually trade the yield. If we think it's too low, we can buy it and benefit from any yield that we get over and above what we buy it at. Let's first look at the earn section on Pendle, which is the simple way to use Pendle. So up at the top right, where you can connect your wallet, you see earn right here. If you click this, it goes over to trade. Now this is the more professional way to do things, where you can trade the underlying and the yield. But if you just want to fix your income, you can go over to the earn section. And so what we can do here is see all of the supported cryptos that we can fix yield for. So you have some ETH staking derivatives here. You have some stable coins that are in various protocols. And then we have staked ETH here, which is very simple, just staking ETH. And that will pay staking rewards from Ethereum. And instead of leaving our token open to fluctuations in the yield, we can literally just sell that expected yield to someone else, and they're going to fix our income for us. Now, of course, that may benefit us because we know exactly how much we're getting. But of course, we may miss out on some upside on the yield actually going higher. So it depends what the individual investor wants to do. So let's have a look at this on staked ETH, which many people know, a simple staking token. It yields around 3.5% at the moment. And so what we can see here is that if you have staked ETH, instead of just keeping it in your wallet and having that, that yield income fluctuate maybe down to 2%, maybe 3.5%, maybe 4%, you can just say, I've got staked ETH and I want to earn a fixed income for that. Now, there's a couple of different points here. The first one is over a certain period of time, you have to fix that time, and that has to be part of the contract. So you can see different maturities here. So there's a 321-day maturity, 685-day, and 1,420 day, because you have to enter into a contract essentially where you're saying, I will give up the yield of this token for a set period of time. And the other person says, yes, for this set period of time, I am going to pay you this yield. And so what we can do here is actually deposit into here and then get this fixed income. The way that the fixed income works and that we know it's fixed is via actually trading the principal token at a discount. So as an example, if you were to get a fixed yield and you have, let's say, 1 staked ETH and you want to get that fixed yield, what you're going to do with the other person is trade this 1 staked ETH at a discount to par. Now, 1 staked ETH is always redeemable for 1 staked ETH at the maturity of the contract, which you can see here are different time periods. The way you fix your yield is to trade this at a discount. So what you'll do is you can redeem 1 staked ETH in 600 days. And if you're trading right now, essentially you'll be trading and buying like 0.95 staked ETH. And so what happens between when you enter the contract and when the contract ends is that the price slowly moves up to eventually meet that 1 staked ETH. That's how they give you the fixed income, is that you will be redeeming that 1 ETH right here, but they will be trading with you at a discount to par. So when you come to redeem your staked ETH and your crypto asset, you'll be redeeming at 1 for 1, but you're trading at a discount to that, and they're giving you that. And so they give you that as a fixed income. And as we get closer to the maturity, the price rises, of course, from that discount up into par. So that's how we get our fixed income. So they have to pay us this. So this is a contract that obviously Pendle is going to interact with us. You don't need staked ETH to actually stake in this contract. What we can see here is that you can actually put in some other different tokens as well. So if you just have ETH, you can actually do that here. What you're doing is swapping a balance and then redeeming for the staked ETH at the end of the balance, right? So it doesn't matter what you're using, because what you're doing is exchanging value here between yourself, who is buying this token at a discount, and them who have the liability of having to pay you this token at the maturity. And so whatever that difference is, that will be the yield, right? So whatever you trade, the discount changes dependent on what the fixed income is for you. So if you want exposure to an asset like staked ETH or the other ones, then you can trade on here and buy it at a discount to par, which is 1, and the discount will be the yield that you get. And so you exchange value for this token. That's what you're going to get at the end of it, and you're buying it at a discount, and that is your fixed income for this asset. What are some risks here? Well, of course, you have exposure to this asset now, and this can go up and down in value during the maturity. So you have obviously a risk position in this asset now. And the other one is you may be giving up your yield. You may be fixing your income at 4% and the thing may yield 7% over that time. And so they're the two risks. Now, when you have this position in Pendle as well, you can trade out of this position at any time. So if you hold the position for, let's say, 30 days and you have 200 days left, you're not fixed in here. You can take your token and trade out of it at any time. However, that token will be subject to price fluctuations dependent on what the yield actually is and supply and demand at the time. So there are risks here if you want to redeem early, but if you know that you have a token that you want price exposure to, like staked ETH, and you know that you don't want to do anything with it for a set period of time, then you can fix your income here. And it may not be the best trade for you, but fixing income is something that's desirable for a lot of people. Now we look at the more advanced section on Pendle, which is where you can trade both the PT and the YT. So if you click up here and just go over to trade. So from here, this is where these tokens have already been split up into the YT, which is the yield token, and the PT, which is the principal token. Now remember, the principal token is the fixed income part. So if we buy the PT, we know that we're redeeming at the end of the contract at 1. And so if we're buying PT, we're essentially buying 1 at a discount. And the extent of that discount is the yield that we get, right? If we know we're going to redeem at 1 for certain, and we're buying at 95, then that price difference is our fixed income, because we know fixed, we're getting 1 at the end of the contract. And so whatever we're buying PT for, that is a fixed income instrument at this point. And so you can buy that, and essentially what you're doing is gaining price exposure to the underlying asset with a fixed income component, which we know exactly what it is. You also have the YT, which is buying the rights to the yield, which is variable. And of course, the yield can change over time. And so you can buy the rights to the yield of a token at a cheaper price than it may yield. That is a risk because this has a floating rate. We don't know what that is. So let's have a look at some examples here. We have AUSDC, which is dollars that have been lent out on Aave. Aave interest rates are variable over time. So this is a risk that we're taking with the yield there. If you look across, you can see the yield token is trading at a certain price right now. And there is a positive interest here. There's a positive rate of about 16%. And so we have the principal token here, which is, we know, a fixed rate. So that's 5.88% right now. So we know if we go ahead and buy this PT, we are getting a fixed rate of 5.83%. And right now, you can see that the YT, where it's trading at, the implied yield of YT is this. It's 5.837%. So if you're buying YT right now, you're paying 5.83% to the other people that are fixing their income. So if you want to buy this yield token right now, the underlying or implied APY that you're buying it at is 5.8%. Now, the underlying APY, so the APY that's actually happening on this market, on Aave right now for USDC, is currently 6.2%. So you're currently buying the yield, and you're paying 5.8, and the current yield is 6.2. So you're currently getting it at a discount to what the token is yielding right now. What that tells me is that this market believes that the current yield that is happening right now is going to drop, right? So the market right here is saying 6.2 right now is a little bit high. We don't think it's going to stay there. We're bidding 5.8 for this token, for the yield, right? We think that over the expiry of this contract, maybe it's 100 days, we think that the yield is going to be around 5.8% over this time. The current yield is higher. So if you think that 5.8, the current market, is pricing the yield too low, you can buy the yield token because you're getting a discount. If you think that 5.8 is too high, then you wouldn't buy this, right? Because you think the yield is going to be 4%. You wouldn't buy the yield at 5.8 if you think it's going to yield 4. What you'd go and do is, go and buy this one, the PT, because you're getting a great deal. So that's the difference between YT and PT. You're basically trading the expected yield of a token over time. Once you've decided you either want fixed income for your asset or you want to buy the yield because you think it's trading too low, you can click on one of these options. So we'll stick on USDC and we'll click on PT first. So what we're doing here is taking some value in our wallet and buying a position in a fixed income dollar for this example. So we can put any amount in. And what we're going to do is swap that value into a fixed income instrument right here that we know we're getting. The implied APY is 5.8%. You can see that here we have a fee and we have some slippage for the trade. So we can go ahead and press swap. So we're buying the fixed income instrument at this point. Now what you can also do is buy the YT, so we can click that. And as we can see, we can swap our ETH into the yield token. So what we're getting is, the yield token and all the yield that comes into that token. So the implied yield that we're paying is 5.885%. This one right here, you can see. So that's what we're paying for this token. So as long as this token yields above that, then we've got a good deal for this token. If the APY comes in below that, then obviously we've paid too much for the yield. So you can of course keep these to maturity. So the principal token has a maturity. So there will be a maturity right here, which is 27th of June, 2024. It's making this video. So you can keep that to maturity and you get exactly what this is because it's fixed income. This one right here, the YT, once you buy this, you gain the rights to all of the yield for this token up until this date, that expiry. After that, this token doesn't produce any more yield for you because we're just trading within this maturity. So you have risk in this YT, and of course this PT is fixed income. Because both the principal and the yield token are separate tokens in themselves, and they have maturity dates, there is an element of fixed income here where you may think, if I'm having a fixed income with a maturity date of 100 days, I need to keep that token for 100 days. That isn't true. We can trade in and out of the tokens at any time on Pendle. There are markets for this. And so what this does is create a way to make a capital gain from trading yield, right? So let's say we bought the yield token and the current implied rate is 5.8%. So we get all of that yield. And if the yield goes up and the implied yield in the market goes up to say 6.8%, and that means that that token is yielding more money. So that's great for us because we have the yield token, which means we have the rights to all of the income that accrues to that token over the 100 days. So we can just keep it and keep that yield. But what it also enables, because this is now tokenized, is that we can trade this token by itself for capital gains and losses. So we don't have to wait 100 days. What we can do is buy the yield token at 5.8%. So we'll click this. All right, and so now we're buying this yield token at 5.8% yield. But if the yield does rise up, let's say 20 days after we buy it, that means the implied yield is now up, which means this token is now more expensive to buy. We bought at 5.8% implied yield. We can now sell it at 6.8% implied yield. Now what we can do here is just swap this around. So we go to swap this. We now have that yield token. We can swap it back into any other token. So what we're doing is making a capital gain on the fact that the yield token has had a boost in the implied yield. So rather than just waiting for that yield and saying, I want to buy yield here, I want to get the income and I want to wait 100 days, you can actually trade this for capital gains and losses. If you do want to trade the yield token like this, we can use the calculator on Pendle to show us just how volatile the yield token can be, because you are trading yield here. So what you're looking at is for a percentage move, for 1% move in the implied APY, the yield token can move in price quite significantly. So we're going to go for USDC here again. We know that the yield token is trading with an implied yield of 5.8. And currently the yield in the market right now is 6.2. So it's trading underneath that. If we go to calculator, which is in the bottom right-hand side of the app, go to USDC, put both of these on, principal and yield. We'll click this maturity and $10,000 here, click calculate. The current yield in the market is 6.249%. So if it stays like that, then you can see that the yield token is cheap and yielding us an effective APY of 9%. So you're taking significant leverage by taking risk by buying the yield token. The principal token is fixed income, and so it just stays as it is. If you just held the underlying, you can see you get the actual rate, which is this, which we think it might be 6.249. That's what you get. So by buying yield, you're taking leverage on the change in yield from what's implied to what's actually happening. Now, to show that, if the average future APY is actually 7%, right, which is above what the implied yield of YT is trading now, so a 1% move in the implied, in the actual yield that happens, we can see here that the YT is significantly more in terms of our profits. So if we buy YT when the implied yield is 5.8 and the implied yield goes up to 6.8, the leverage that we're taking on that move is significant, and we're making a 60% gain, even though the underlying the actual yield that happens to that token only goes up to 7%. Obviously, it is the percentage move in that price. It's almost like trading leverage at this point. So buying and selling that YT can have significant moves over and above the fixed income portion and the actual underlying rate of income that comes to the token. Because users on Pendle are trading in and out of these tokens all of the time, the PT, YT, the underlying, they use Pendle's AMM, which is a decentralized exchange, to trade these tokens. And so what we can do, just like any other decentralized exchange, is provide our liquidity onto here in order to give liquidity to traders and get their trading fees. So some of these pools are offering pretty good APYs as well. So as an example here, wrap staked ETH. So if you have or you want exposure to this asset, we can get 10.85% currently out of the liquidity pools here. So this is just like providing liquidity on Uniswap or something. The difference is, because a lot of these tokens are very, very similar, you have very, very low impermanent loss. So if you are putting two tokens that are very different and they have a big price discrepancy between them when you're providing liquidity, you have impermanent loss, which takes away from the yield that you're getting. But because these tokens are almost the same and the yields are maybe 5% or so, they're not going to change very much in price. And so they have very, very low impermanent loss, which is a good thing, which means that we can make higher yields on it. So if you have wrap staked ETH or you want exposure to wrap staked ETH, you can do that here. You can just zap it in. So wrap staked ETH here, you put some in and it's going to swap that token into the liquidity pool token. And we are providing both wrap staked ETH and the PT, the principal token of wrap staked ETH. So the fixed income instrument of wrap staked ETH, which is probably yielding around 3.5%, 4% right now. So the price difference between these, when you're holding them in the liquidity pool, is going to be very, very small. And so impermanent loss isn't going to be there, but you get the trading fees from traders that are swapping these tokens. And at the moment, it looks like you're getting a boosted APY from Pendle. So you get price exposure to wrap staked ETH, very low impermanent loss, and currently 10% yield. That boost will run out at some point, but that's how you would do that. If we go to another example, let's say AUSDC, you're getting 30% yield on providing USDC with the principal token and USDC here. So, traders that are trading in and out, and of course the boost as well is obviously pretty good at the current time. Another one are ETH. The boosted yield's a little bit lower, but as you can see here, you have the principal token and the underlying staking derivative, both in a pool with a decent yield from trading fees and the boost here. Just watch out for the liquidity of some of these pools. It's quite low on some of the pools, but that is a way to earn extra income. Now here, you keep price exposure to the asset that you're trading, and the yield that you're getting is variable as well because you're providing liquidity in a pool, and trading fees and volume determines the rate at which you get. So that's something that's just completely separate from actually trading the YT and the PT. This is just a liquidity pool on Pendle's market, which just so happens to be a pool that is has fairly high APYs right now because of the boost that they're giving.